Welcome everyone to my midweek stock market update. And I want to get right into it. It's a lovely day outside, so you probably don't want to be looking at the stock market longer than you need to. Now, you're going to need something really important during the course of this. You'll want a phone to take some pictures of the stocks that I like the look of and where the money's being made and my views, given that we've had a bit of a pullback, given how much money's been made recently and all of last year, it's not a surprise. So let's get right into it. I always like looking at these seasonality numbers, not because the past is a guarantee of the future. If anything, it's not, but it's always interesting. And we are at April, which tends to be one of the strongest months for both the NASDAQ and the S&P 500. So, well, what does it mean? Read into it what you wish. You're more than welcome to take pictures. Thank you, David. You guys have already, you're well trained because you know I always ask, where are you from? And we've got Dave from Cardiff, Steve from Swindon. So do let me know where you're from. Pete from Leeds. We did well this week, didn't we? Chaz as well. Early Birds, Nottingham, Pinner, Bradford. Did your wife go with Starling Bank? No. She's never worked with Starling, but there might be another Mrs. Patel. Carwyn from Gower, Swansea as well. John, Nottingham, Hertfordshire. If we've got anybody from outside the UK, let me know. So some interesting numbers there. You can take a picture of them and have a look later on. Where are we on valuation? Still, most things looking expensive. Red is expensive. It means you're paying $31 for every dollar of future expected earnings. Energy, healthcare looking, again, cheap, particularly the healthcare plans. And I'll come to that in a second as well. So we've got some of the healthcare companies, energy, and that energy's been there for ages. Financials. And you might argue, well, financials are cheap because of interest rate expectations, whatever it is. We'll have a look at those. And telecoms looking cheap. But of course, haven't been the ones, other than telecoms, which have made the big money. The big money's come outside of that. So I reiterate the point I make every single week in this, that this is valuations. If valuations alone were the things that moved the market, then all we'd do is go for green and not red. However, it isn't valuations. That's why we tick not just the valuation box, but the growth in profits, in sales, okay, dividend yields, and all these other factors as well, because indeed they're all important. And as I made my April list, these were all the ones which did not make it into our filter. So we filter the April list there. None of these have made it into the filtered list. Why? Because there's other companies which have a better valuation, better revenue growth, maybe better cash return on capital invested, higher sortinos, which is higher returns for the volatility. And when the market rises, there's others which rise more. And when the market falls, there's others which don't fall as far. Then all of these. So look at how stringent we are. It's a bit like showing you the entrance, I don't know, the people who got into Harvard or Yale or Stanford or something, or MIT or Oxford or Cambridge. And I'm saying, well, all these were the applicants who didn't make it, or Goldman Sachs, I don't know, pick whatever. And none of these were good enough. So you can see that when people say do your own research and due diligence, I will tell you some of the ones which did make it and what I think about the existing holdings that I have in the broader market in just a second. But when somebody says to you, oh, it's really hard to beat the market. Yeah, because the chances are you're going to end up picking one of these, which have a lot wrong with them. Sadly, people don't create companies which all do wonderfully well. If humans did that, my job would be a lot easier. So would yours. Your pension would do a lot better. Why does your pension perform poorly? Well, one of the reasons is all your savings or your investment account is because there's just a lot of companies which don't have growing profits, don't have growing sales, and you're paying too much for the profits that they do generate. So that's one of the reasons. So none of these made it. What did? I will come to that in a second. And like I said, we don't just look at valuation. The S&P, by the way, this is unusual. This caught my eye. So I'll share with you in these things that caught my eye. Learkit, welcome on board. Learkit, don't forget, you'll also get, because you're part of the investment program, on the private Telegram channel tonight, you'll get the Great Investments Program client version of this, which is different and detailed, etc., etc. So do watch out for that. Wonderful. We've got a good array of people who've joined. Hello, everybody. Welcome on board. So this was interesting, just out of interest. I will draw to your attention in these weekly updates things which I find just curious, not necessarily anything to be, no action to be taken. They're for information, not for action. Okay. So sometimes how I do my emails to colleagues, for information or for action. It's either one of the two. And this is just for information. Nothing at all to be read into it. Do not draw conclusions for it. But it was interesting that S&P is beating the NASDAQ 100. So be it. NASDAQ tends to be more tech-rich. S&P tends to be broader. Now, I wanted to show this because oftentimes on my social media videos, particularly on TikTok, I'll get somebody saying, oh, just buy the S&P, just buy the S&P, just buy the S&P. And of course, you could if you wish. It's just that, well, there were 52 years of zero returns in that period, 26 years of zero returns there, 13 years of zero returns there with the S&P. And you might say, well, yeah, well, that's history. It's not going to ever happen again. Well, okay. So this is an S&P tracker. That's 0% returns for, what's that, 18 months? Okay, 0% for 18 months. There's another 0% for 18 months. And that's since 2018. Okay, so 2018 to 2020, 0%. 2021 to 2023, 0%. So since 2018, there were 36 months of 0% return. And you might say, well, that's fine, because in those 5 years, that's only 36 months. It's only 3 years out of 5 where you had 0% return. Well, in 2022, you actually had the market falling, but that's besides the point. So what I'm saying is, and you might say, well, that's an argument for just buying and holding. Well, actually, you can end up prolonged periods of getting 0% if you're just buying and holding. What we want to do, we're not trying to time the market. We're going to hold for 12 months. But what we want is the kind of companies which should, because they tick the value, growth, income, cash flow, Sortino box, is that if the market is rising, we should do incredibly well. And if it's going sideways, then those stocks should be the ones that there's the flight to quality. They're the quality companies, undervalued, growing, dividend deals, cash flow positive, high alpha, high Sortino. And if the market's falling, they should be resilient. Doesn't mean they'll necessarily go up, but they should be resilient to fall. So all we're trying to do is just tweak things a little bit. Otherwise, yes, you can have an S&P index tracker and there's one for you. Good luck. Okay, perfectly fine. Right? So in 2022, you'd be down 25% and watching it drop. And that's fine. You might say, well, that's okay, because in 2023, it went up 25%. Yep. So if something goes down 25 and then rises 25, you're back to zero. So over 2 years, you would have 0% return. Whereas if you made a little bit of effort to try and avoid the falls, which I'll show you how we do, then, and it's not timing, just once every 5 years, you have to just sidestep the falls, then it saves you a hell of a lot. Well, you get to keep a lot more of your money, basically. And usually the extreme example I give of this is Meta, and I'll do that in a little bit. Well, actually, this is quite useful. Rate of return, 5%, 8%, 12%. Investment horizon, let's say it's 25 years. God forbid, 75 years, okay? So let's just look at the 25-year investment horizon. You get 5% growth, right? You might end up with 57,000. 88 if you've got 8%, 161 if you've got 12%. However, a small difference in returns has a massive change in your wealth, because if the return increases from 5 to 8 or 8 to 12, you can see you can go, well, from 5, and you might say, well, that's easy for you to say, 900,000 becomes 49 million. Yeah, well, you've got to start off with 75 years. I haven't got 75 years left. But you can see how it can make a significant change. Okay, so it's, I think, a lot easier than getting a time machine and going back in history, because that'd be easier, start sooner. Saving lots of money, well, that's bloody difficult with cost of living and disposable incomes. Probably the easiest thing, therefore, to do, other than starting sooner, which, sorry, we are where we are, can't make time go backwards, and saving more, well, thanks very much, have you looked at the economic environment, is improve your returns. And we're talking by small amounts, and 12 is too little for me anyway, given last year the S&P was up 25%. So we're going to talk about all of these things and how might we do it. We'll talk about NVIDIA, Meta, Alphabet, Amazon, Apple, and so on and so forth that you can see on screen. And like I said, my approach to all of this, exactly as Alan said, down 25 needs an increase of 33 to get it back to zero. And this is something which I did in my Financial Times columns once. I explained this. I said, if something drops 25%, and then rises 25%, where are you? Let's do it in reverse. Let's say something rises 25% and then drops 25%, where are you? And I said, in both instances, you're below your original 100. And people were perplexed. They said, wait a minute, Went up 25 and then dropped 25. I'm below 100. Went down 25 and then up 25. I'm still below 100. Where the hell did the missing money go? God's little trick with mathematics. And this is what people often don't understand about why it's so important to make sure we don't have those deep dive drops. And what do we do to protect it? What's my seatbelt? So they all think, oh, this is all about picking the right companies. If the company's doing incredibly well, yeah, well, guess what? If the companies haven't been invented to do incredibly well, occasionally, yes, you get a Meta, you get a Crocs, as we did in previous years, Generac, or an NVIDIA, or whatever. Yes, but there aren't enough of them around. So you've got to do the other half, which is make sure we don't get the big drawdown. So we'll talk about how do we avoid that. And the simplest way is mathematics. Is the best way to avoid it. And I'll explain what I mean by that. Not trying to foresee into the future, okay, which is the biggest mistake people make. They try and rely on narratives and stories and not just simple objective maths on when to exit, because maths you can't argue with. So we're going to have to tick a value box, a growth box, an income box, a croaky, which comes from Goldman Sachs Wealth Management. And we're going to do all of this, momentum, Sortino, and alpha. Okay, over the past week, this is what the market did. Pretty ugly. Right, the healthcare plans took a bit of a hit. There was some negative news about Medicaid. It wasn't particularly negative. There was a 0.16% less money than would otherwise happen. Now, when stocks make big downward moves based on almost negligible news, it's usually because people are looking for an excuse to take profit. It's not hard bad news, which means hard bad news when a company goes down and then will continue lower. It tends to be, which is things like specific to the company. Our profits are rubbish and they're going to continue being rubbish for the foreseeable future. That's hard bad news. Soft bad news is, well, the industry might make 0.16% less than we thought, which means the stocks drop, but then they usually rebound. And there's some research on hard and soft news that I've published on one of my programs. But anyway, don't worry about that for the moment. I'm just explaining it to you. So it wasn't something I was particularly worried about. And obviously some profit taking off of NVIDIA. We'll come to that in a second, and whether I'm going to sell some of it or not, and why the people who've sold it prematurely just simply been wrong time and again, and how you avoid that sort of premature leaving of a company which is doing incredibly well. So where are we on this? That's where we are. I mean, well, there isn't much for me to say on that other than let's deep dive into specifics. I mean, what does that tell you? Nothing really, other than just a bit of a hodgepodge. Nothing to read into it. Similarly with ETFs. Now, last week I did a detailed weekly update, which included about 20 exchange-traded funds. You've all come onto this webinar. I'll tell you from my April list. I'm not going to show you everything, obviously, on there. That's the clients. But I'll show you. I'm going to share with you one or two of the ETFs which caught my eye. Give me a second because I want to go through it. And now, I'll show you. Ooh, I'm not sure I can. Okay, I've got to show you this in a way without showing you all the others. So if I look at the Invesco S&P 500 momentum, all right, which I don't own because I don't have, you can see that it has done incredibly well, and there's probably going to be a limit to the upside on this, and that worries me with some of the momentum-based ones. But yes, there is an exchange-traded fund which just looks for momentum and doesn't look at value or growth. I'm not saying it's a good idea. What I'm saying is, when you look at the S&P, and I'll come to the S&P in a second, I'll come to more ETFs in a second as well, that there is room for limited upside, because that's the whole point of an exchange traded fund: lower volatility, less upside, unless you use a leverage one like I have in my son's junior ISA, which is 2 times leverage Microsoft, Amazon, and Alphabet. And I think, and I've got to check, 3 times leverage S&P 500, but I've got to check that because I can't remember. If you look at this, the world momentum, I think that's got a bit more room than just the US. Okay, so that's enough of sharing the good stuff with you. But yeah, I did one last week on exchange traded funds in more detail, so it's there in the internet on my YouTube channel on the weekly update. I went through about 20 exchange traded funds. US stocks have had periods of high concentration during the past century. Yeah, people go, oh, it's just a few stocks which are leading to this. Well, I don't care because I only have a few good stocks in my portfolio anyway. This from Goldman Sachs. Market cap of the largest stock relative to 75th percentile. Anyway, this level of concentration, well, we've had quite high concentration levels before. You can see it there. Okay, so it's not the first time, right, that we've had it. Anyway. I'll tell you what's interesting about this. That's Goldman Sachs. This is from Ken French. You won't heard of Ken French. Ken French collaborates with Eugene Fama. Eugene Fama I've written about many times in my books before he went on to win the Nobel Prize in Economics. Anyway, just as an aside, I just want to tell you. So if Ken French comes out with the research, I found it interesting. Again, this is for information, not for action. Concentration is not something which necessarily worries me. Markets year to date, the S&P is up 9, the Nasdaq up 7, and that's what that other chart was about. That rarely happens. Usually the Nasdaq is above the S&P. What does it mean? Well, I guess if you were tracking index and you were into pairs trading, this is going to get complicated now. You'd go long the Nasdaq 100 and short the S&P 500 in a pairs trade, as long as you had hedged them perfectly. So you did them, you'd look at their relative betas and you'd buy in proportion to the betas. Over the heads of 99% of people, but I suspect that's a trade which some of the traders are going to be doing, going long NASDAQ and short S&P. Not enough to move the market, so don't worry about it, because they're two of the most liquid futures contracts that there are out there. But anyway, out of interest, that's where we are. The S&P is up 9% year to date. And what's leading the way? Well, energy. And this is why I like to break down where things are coming from. Energy, actually. The energy stocks. And I'm going to show you some of the healthcare and energy stocks which have come up on my April list as well. Communications, financials, industrials have come up in April a lot as well. And what is B? Materials? Is that materials? I think that's materials. Okay, and then you got to go all the way down here to get technology. So everyone thinks, oh, it's a tech rally of concentrated of a few companies. Actually, no, that's where the money's been coming from. I don't tend to look at sectors, as you will know. I take a very much a bottom-up approach of looking at 10,000. Bottom-up means starting with the stocks. Okay, and I don't care what sectors they're in. None of these made it, by the way, but I don't care what sectors they're in. You can sort of see the sectors. I care about whether these factories for making money are actually making money. All right. Imagine I'm the CEO of my own family office and I look at the data and I say, right, those factories are not making money. I don't want anything to do with them. Those factories are making money, and companies are just factories for making money. If they're not doing it well, then they shouldn't be in my pension. They have no right to try and manage my son's inheritance. He's not going to get one. I don't believe in them. Now, what have we got in terms of the factors? Well, momentum, yep, which I'll come to in a second as well. And we've had some, what's that? Is that small cap value? Purple is small caps as well. So they're making a bit of it. And then you got some more momentum. What does any of that mean? Well, you can see that a lot of factors are not making any money at all. And God forbid you were in small caps generally, because look at that. You got absolutely screwed. But we'll talk, well, we're not playing around with any of this. And again, it's for information. What I do is I say, well, screw all of that. I want companies which in the universe of all companies are undervalued. So it's those, are growing and undervalued. So that's that. And then are producing an income. So that's that. And then have got a good growing cash flow. Then that's that. And then have got high Sortino and alpha. So it's that. That's what I'm selecting from. Okay, that small universe. And that necessarily will pick up the momentum ones because we looked at momentum in there. It was the third circle in, as it were. Markets over the past year. Dev, you can use free platforms like Yahoo Finance. So that'll give you the charts with the indicators at the bottom. Markets over 1 year, it's free. I'll try and tell you as much free stuff as possible. Markets over the past year, Nasdaq's up 37, S&P 26. Now, ideally, that's what you want your pension doing, obviously. Okay. The UK markets are up 10%. So there we go. S&P 500, this is what we're all here for. Obviously, we've had a bit of a wobble, which when you put it in context, as that policeman famously said, who's gone viral on the news, when you put it into context, look, it's hardly a blip. You know, and I want to teach you something new, which I've never put it in these terms before. I think I might have in one of my old books, and I remembered it again. You can all hear me, okay, haven't you? Kid said Verizon's not on the approved list. Yeah, you hold for 12 months. So we're not trading, so it doesn't matter if the next month something's not on the further filtered. It doesn't matter because you're not trading month to month. And I continue holding it because remember, you're holding for 12 months, or if it drops 25% from the peak, that's the simple rule. People have a tendency, naturally, humans have a tendency to gamble and trade. each day, each week, each month. When you're investing, you're holding for 12 months. So it doesn't matter if something you bought in January and is no longer filtered, because it shouldn't be by around June. It should be so overvalued and have gone up 5 million% that it shouldn't be something you'd want to buy in June. If it's the same company you'd want to buy in June, there's something wrong. It means it hasn't bloody budged. Okay, so you ideally want the kind of companies which, once you've bought them, you wouldn't want to buy them again because they've gone up so much and they're overvalued now. Like Nvidia, I wouldn't want to buy it now. Might want to in 5 years, who knows, in 3 years, in 2 years, in 1 year. But today I continue holding what I've got. I'll come to that in a second. And it's a very important point to make. What I tell people is, when you're looking at something, whether it's the S&P or anything else, something really important I want to tell you. Well, first of all, I think the monthly momentum, which is this, is rising. Now, I'm going to teach you a few little things here, okay? So one thing that I like to do is I go back and say, well, where was it previously at this level? Oh, it was here, and then it went up there. That means it had a rise of from 41 to about 48, okay? So it had a 20% rise. All right. Now, I'm not saying it's going to do that again from the levels it's at already, but it had a 20% rise in the past when it was at similar levels. Also, what I like to do is say to people, well, wait a minute. What's what I call the drawdown danger? The drawdown danger. And you might want to write this down. Drawdown danger is how much something from peak to trough can fall. That's a drawdown. Okay. What's the drawdown danger? Nobody likes drawdowns. It is the depth of the fall and the duration. Okay, so what's the depth? That's the depth. Okay, what's the duration? Well, it's until it got back to where it began. All right, bigger this square, the more surface area of this square, the more drawdown danger. In other words, the less you're going to enjoy the ride. Right, it's going to be more volatile. Doesn't mean it won't shoot up, as it did, but it's going to be a bit more like a roller coaster, which makes you throw up along the way. All right. And it might not suit your personality. You might have the kind of personality which can only take boxes like that. All right. Some of you might be, yeah, I'm relaxed. I'm old and gray like me. I can take boxes like that. Some of you will want to be that person. You're just not. You're really that kind of guy. All right. Or gal. Right. And what I want to show, I wanted to show you that drawdown danger. Have a look at the recent historic past. It's not a guarantee of what the future looks like, but it's a pretty good idea of whether or not you're going to enjoy the ride of the stock that you've purchased, or index, or ETF, or whatever else. It's a pretty good guide. However, what I do is I don't ever own anything, as you will know, when this monthly MACD is falling. Okay, as you know, I do not do that. If it's falling from a high level, okay, so in the top 25% of this graph, and it's falling, especially if it's crossed its own moving average, then I don't want to own something. So in this case, we were in cash for most of 2022. But you might say, Alpesh, that means you're rubbish. If you held cash in 2022, and you can look on my Telegram and my YouTube videos to check all of that, then you're rubbish because you didn't pick companies that went up. Well, if you haven't invented the companies which go up and which are safe and credible and are undervalued and high growth and good cash flows during a falling market, it's not my fault. It's your fault. You didn't create those companies. You go out and create them and I'll buy them. They didn't exist. Or you might say, well, no, you missed one. This one existed. I said, okay, fair enough. I missed it. At least I held cash and didn't drop 25%, which is what the S&P did. 25% from peak to trough. Okay, 25 down there. From up there, it might have been 23. All right, peak to trough. Okay, well, if that's falling, I don't ever want to do that. So I've taught you quite a bit here on that one. Anyway, bottom line, how are things at the moment? Well, we know when this is rising that you can get some of these drawdown dangers. You can see it there. You can see it here. There's a drawdown danger. Okay, so don't be surprised if you get another drawdown danger of that much. Don't panic, as long as it stays within that box. But, you know, like I said, I'd only panic if it moves below that moving average. I hope you like that. That's a new one. Oh, I froze for 15 seconds. Sorry. I thought something had happened. Apologies for that. FTSE 100, well, it looks like it might actually do something for a change. It looks like it might sort of replicate what it did here. which means it sort of goes up for a little while and then drops and then goes sideways and then thinks better of it and then goes nowhere. NASDAQ 100, well, it's had a bit of a blip down first 2 days of April. Markets have been open. That, and you can look at that and say, well, what did it do the last time it was there? Which isn't a guarantee, but it's sort of better than nothing. Oh, look, it still had that much. But what are the drawdown dangers? Well, the drawdown danger is probably about that much, which is okay. So don't panic if you get a couple of losing months. Apple, as you know, I sold 50%, might possibly sell more, given that it's fallen below its moving average. You can see it there. The blue is well below that, and that's when I got out of it, as you know, a while back, 50%. The other 50% remains on hold. So would I buy more at this? No. Would I hold what I've got? Yeah, 50% I'm holding. Would I sell more? Might do, probably should do. If I was risk averse, I would. Are you risk averse? Then definitely do it. If you're risk loving, then no, you'd continue holding it. Every time the weekly MACD, which is a solid blue line, gets to about these levels, what's happened? Well, it's had a bit of a move up. Well, not there. It's sort of, and then eventually did. And I'm just anticipating that this might go that way, or it might drop a bit, then go that way. But for the moment, I'm happy to just hold with half of it. And I was happy to have sold half of it because I just had. So, here's the other thing. Okay, I'm going to let you into another little thing, which it's not a secret. I've said it in my books. So if I've got 20 positions and I put equal sums in each of them, which is the starting point, 5% in each, because 5 times 20 is 100%. I will, on some, what I call my quality 5, go up to 3 times as much in those. Ignore the leverage positions. Okay, so I might have up to 15%, say, and in my quality 5, which traditionally have been the 2Ms and the 3As, Apple, Amazon, Alphabet, Microsoft. 2Ms, Microsoft, Meta was the other one, all right, and the 3As. Now, at the moment, as you know, Apple I wouldn't buy more of, and I had a lot in it because it had since January 2023 had done that. And I had 15% to begin with of the whole portfolio. So I didn't mind selling 50% because it was getting a bit expensive. Yeah, well, I had a lot. That will be for the Great Investment members only. So look, you will see that tonight on the broadcast. I'll go through that and a whole load more. Microsoft is, well, look, you tell me. That is obviously a overbought. The last time it was there wasn't much left for it to do other than fall. So I'm going to keep a close eye on it. If you're risk averse, you might already take some of your profits. Remember, don't forget, I've got a bunch of double leverage Microsoft in my son's junior ISA. I've got a bunch of ETF, and I've got 15%, and that was back then of my portfolio in Microsoft. Now, to some extent, that 15%, whilst it's gone up, what has it gone up from 280 and 429? So about 100% has decreased as a proportion of my portfolio. Hasn't gone up 100% as a proportion of my portfolio because more capital's been added to the portfolio, and other things have gone up as well. So it swings and roundabouts. So anyway, it doesn't have to be that precise. All I'm saying is, were I to sell some of this and take a bit of profit, I wouldn't be too worried or bothered right now. So would I buy more right now? No, I think I'm going to hold off for the moment, just for the second. Am I continuing to hold what I've got? Yes. Would I sell? Well, not yet. But if I was risk averse, if that drops 5 to 10%, I might sell. If you're risk averse, you might sell 50%. If you're risk loving, you might wait for it to drop 15% before you do that. If it drops 25%, then I'd sell 100% of it. But you might say, I don't want to wait 25%. Fine. Then work out what your X drop is for Y. Now, some of my students say, well, what, why would you wait? Just sell it now. Sell it now. Well, wait a minute. Imagine you've got a golden goose. Sorry, a goose that lays golden eggs. And it's in the middle of laying an egg, like Microsoft is. It's forcing this egg out. And as it's laying this egg, you get a knife and you go, and that's you gone. And I come up to you and I say, why don't you kill the goose that lays the golden eggs? It's probably going to stop at some point, Alpesh, laying golden eggs. So I thought I'd kill it now. Okay. Can you imagine how hard it is for me to have to suspend so many IQ points to discuss that with someone? Sorry. So basically, if it drops X, sell Y. And if it hasn't dropped, then keep hold of it. I mean, you might make X 5%, bit little, given that you can see here, what the drawdown danger is when this is moving up. By the way, drawdown danger you only need to be concerned about when the MACD is rising, because you're not going to hold it when it falls anyway. And when it falls, the drawdown dangers are far more significant and irrelevant to you. Look at COVID, though. We can talk about COVID. That's when we launched the program, January in Novotel, January 2020. And we got, by this point, we had so many clients because they got to steer through all of that and make quite a bit. Anyway, separate story. I probably should do a video just on COVID. So Amazon, I'll talk about on the Great Investments Program channel tonight. Disney, still fine and holding and waiting and all the rest of it. Okay. Don't forget the YouTube channel's got all these videos on IFAs. Now, NVIDIA. Now, what do you do? This is really important. And what's our process when stocks are basically momentum stocks? They're just going up. It's not value, it's not growth, it's momentum. And we have a very simple flow chart, as some students might be aware of this flow chart. And I'll just explain what that is in a second. And the flow chart basically, whoops, where's the mouse gone? Here it is. It says, look, whatever it is, either you're holding for 12 months or, which is the usual rule, or it drops 25% from the high since you started. Now, you might say, I don't want a bloody 25% drop. That's so much profits I'd be losing. I remember we got into this in January 2023, as you can see on my Telegram. And the reason, nothing to do with AI, just simply because it was on the approved list and the momentum wasn't falling. So it's on the approved list. And great, 12 months are up. How come we didn't get in, which would be the normal thing? 12 months are up, you get the hell out of there. How come we didn't get out? Well, because it was a golden goose, which bloody kept, broke the rule on this one, only because, like Meta, just kept giving more money. So we didn't exit. Normally we just exit. Okay, after 12 months, redo the exercise, go through all the portfolio, go through the Excel spreadsheet with a fresh piece of data, which is all fresh there, rather than buy and hold. And I'll tell you why you don't buy and hold in a second. But this just keeps rising. So now it's been over 12 months. Maybe when it drops 10% from the highs, I'll look at selling some of it. Okay. And you said, why are you waiting 10%? Well, I'm not so greedy as to say, well, if it drops 0.1%, I'll exit, because I'll prematurely exit then. Okay. So most months, absolutely nothing to do. Sat on my fat backside all that time and absolutely nothing to do, because it just kept rising. And he went, well, why didn't you sell there? Look, it went sideways. Weren't you worried? Yeah, if you watch my broadcast, I was worried. I said, I think it might have peaked, might have sold. So why didn't you sell? Well, because it didn't bloody drop. If it doesn't drop, what can I do? And then it gave me more money. Kept laying bloody eggs. Did I know it was going to lay eggs? No, I'm not an insider dealer where I know with NVIDIA what they're going to do. It just kept going up. So why would I sell? That was it. Tesla, as you know, we got out of in October, which is looking a cleverer and cleverer decision. And the reason was, well, that I've told you before, the monthly. There you go. There's the monthly. Oh, I think somebody asked me about this in terms. So Yahoo Finance, you can do these monthlies for free. I happen to be using something called TrendSpider, but it's expensive, so don't use it. It's like £1,000 a year. Okay, so don't use that. You want mining? Might have to do that some other time. I'll try the kid, only because I like you. I'll try. So anyway, went up for a bit and then it's dropped. It's not going to be a special situation anytime soon, I can tell you that. So anyway, it's interesting. Wells Fargo said in January, sell. We said sell in October. Well, I sold in October. I didn't say everybody should sell. I just said I'm getting out. Anyway, it was a special situation from January of last year to then. Nothing to do with the news. News is narrative. And if you want to know why news is so untrustworthy as a mechanism for selecting stocks or name recognition or what journalists say, look at what's happening in the Middle East. And how come you've got on the same data one group of people who are saying one thing and believing one thing, and one group of people who are believing the other. And you might say, well, wait a minute, Alpesh, doesn't mean one of them's wrong or nothing. What I'm saying is, in terms of interpretation and opinion, or Ukraine, or I don't know, something else contentious, okay? And trust me, with companies, everything's contentious. So narrative inevitably leads to almost gambling in which way the market's going to go, because you've got to work out from that narrative, what is the market going to think? Right? Which is two things. You've got to first find the narrative, and secondly, what the market's going to think of the narrative. based on how much of the narrative is the market going to read and consume and determine. So I far rather make my life bloody easier. And remember, I've written 18 bloody books on this, so I know about stories and narrative analysis. I'd rather just look at the data, find the filtered ones here, and say, right, it's straight off of that. That's it. Okay, NXP Semiconductors. Yep, we're just waiting. Look, and you might say, but Alpesh, it's gone down for 2 days. Well, 1, 2, 3, 4 weeks. Well, yeah, that's not an unusual drawdown danger, is it? Because you can have boxes which are even bigger. So nothing to do. Qualcomm, really nothing to do. I mean, just keep holding. When I first set up, I don't know if I've told you this story. I think I have. We set up the hedge fund in 2004 at Waterloo Place, which is beautiful. On the one side, you've got Pall Mall, and you're in the intersection with Piccadilly Circus. Okay, so look out of the window from Waterloo Place. On the right, you've got Pall Mall. On the left, you've got Piccadilly Circus. And after Pall Mall, keep walking down the stairs and you get to the Mall. All right, walk some more and you're at number 10 Downing Street, the rear entrance, right? Beautiful location. That's where we were. And we launched the fund and we'd done the fundraising. And I said to my partner, Sumitra Sengupta, what should we do? He goes, that's it. She's got to wait. I said, shouldn't we do some fundraising, speak to investors? He goes, no, you speak to investors once a month. I said, yeah, that's true. Well, should we raise some funds? He goes, no, you just done it. And what are you going to do? You can't keep going back to the same people. They give us some more. It's only been a day. So we went to my place. I used to have a place at Parliament View overlooking the Houses of Parliament, hence the name Parliament View. We sat there in the living room, moved the table to the window, and we chit-chatted. I thought, this is ridiculous. Absolutely ridiculous. That's it. Qualcomm, got to wait. Most of this, you're waiting. It's a waiting game, right? Waiting for daffodils to grow. ServiceNow will be tonight. Netflix, I don't own, but as you know, I talk about some of the bellwethers. Now, we started covering this here after this big move. I don't own this. And I covered it because I said, well, I know it's in the news a lot and the momentum's going up. And that was just the basis. And it's been doing rather well. And somebody said to me on TikTok, you missed it. It's a, 80% gain. I said, well, yeah, so what? There's others that we've got. Can't buy everything. PayPal's come back a bit. This just shows you don't rely on the MACD alone. Don't rely on the monthly that. Okay, because look at this. That's falling and that's going there. That's why fundamentals are important. You've got to look at value, growth, income, cash out. And it's also why if ever I don't stick to the 12-month rule, then I usually get slapped. And even now, there'll be times. And if I don't stick to if the MACD crosses below the moving average rule, then I usually get slapped. And you can see the slap. Look at how bad that drop is. Okay, so 12-month rule or 25% rule or that. 3 seatbelts to avoid even big name companies like this hurting you. All right. There's a whole load of videos on here and here. Want to cover more things. Oh, gee, she's gone and she's not even looked at what she's done. So I have a graphics team, and the person in the graphics team has sent you this. Sorry about that. She's cut and pasted it without having a look, and I haven't looked until she only sent it to me about half an hour ago. So I'm not. So forget GE for the moment. Popular with hedge funds, not for me. Cisco. Well, actually, it is me now because I did buy some belatedly. And that's what we're looking at. And I mentioned this because I wanted to say, look, hedge funds might like something and I don't. Let's see who's right. But it also then ended up on our further filtered list. I don't know what that's there for. Oh, I want to show you this. So I did this last night. This is what I do at midnight. Okay, I was going through some data of 2023, 2022, 2021, and I wanted to pick a bunch of well-known fund providers like Aberdeen, Bailey Gifford, Fidelity, Henderson. I keep getting asked about 7 investment managers, 7IM over there, and Quilter. And I wanted to pick different regions, emerging, European, China, ones that I don't necessarily pick. Income and growth. Well done, you. Okay, Far East, cautious, moderately cautious. And these were the worrying results. These are the worrying results. These are the past 3 years. And you might say, well, it's only 3 years, Alpesh. You've got to give it 75, which is what they want you to do, because obviously you'll be dead by then and can't complain. Well, China, you might say, well, China's been atrocious. Yeah, so why don't they just shut the bloody fund down? Oh, well, we're after. I mean, remember, they're still selling to you then, and they're giving you reasons. Look, read their newsletter, Aberdeen China Fund, and they're telling you every single month throughout 2022 and 2023 why things are going to turn around. For 24 months, they kept saying to you, oh, they're going to turn around, they're going to turn around, which either means they're lying or they're incompetent. So either they're fraudulent or incompetent. Okay, because surely you're being paid to tell people don't buy this shit. Anyway, so I looked at Aberdeen Diversified Income. That's their fund over there. Great, thanks, mate. China, of course, did rubbish anyway. So let's say China, it's not their fault. But they keep selling the bloody thing. They keep flogging it to you, and they keep coming up in their newsletters with wonderful, wonderful, wonderful things. Have I covered Apple? Yes, Matthew. But Matt, are you the one? Are you in Scotland? If you're the one in Scotland, you're in the program. Then it's on later anyway. And don't worry, there'll be a replay, Matthew. So don't worry about that. So I tell you what then caught my eye. Okay, emerging markets, because the narrative is, you know, if I ask my wife, who's by no means an expert, what do you think about emerging markets? She goes, oh yeah, they're supposed to be good, aren't they? Well, bloody hell, thank you. You know, great. And we're not talking, and these are funds that pensions invest in. We're not talking small drops. We're talking 27 bloody percent. Okay, Far East, 21%. 3 years, that's a hat trick. You might say, well, it's really a bloody tough 3 years. No, it hasn't. 2021 and 2023 have been two of the best global stock market years ever. And this is the point that I make. When you pick and have funds which will pick only from a narrow gene pool and saying we'll only pick Chinese companies, only Far Eastern companies, only from a small list, not out of 10,000, which might be the best ones for you, Matthew, or for you, Steve, David, Ian, Alan. You've all got very conventional names. It's not like my son's school. Nobody's got names like Ben, David at his school. They're all called, you know, Ophelia and Lilac and I don't know, Violet. Anyway, must be people interested in the stock market are born in a different era, obviously. Apologies. Well, you don't want to pick from a narrow gene pool. You need to narrow it down because the vast majority of companies are rubbish. Oh, by the way, that's the other thing. Let me break some news to you. The vast majority of listed companies are rubbish. Okay, if you don't believe me, how come that drops 27%? If the vast majority of companies were brilliant, surely an emerging markets fund would do well. I'm not even going to blame the fund manager. He's been told you're only allowed to pick from emerging markets. You're at Fidelity, mate, one of the largest funds in the world. Presumably, you're talented to some extent. Let's assume he's good, the company's good, but he's been told, and this is the fatal flaw, you can only pick emerging market companies. Clearly, it must be the companies which are crap. Obviously. If they're all great, he would have done well. Not his fault. I'm going to take pity on him. Henderson, Far East. So I went, okay, let's go to the other extreme. Let's look at cautious. This is not cautious. None of this is cautious. China, emerging markets, Far East. Are you nuts? Far East, cowboy country. 7 investment management, cautious. Great. Cautious loses me 11%. What's your definition of cautious? For God's sake. Okay, minus 0.3, up 1.6. Over 3 years, you've lost me money. You're not cautious. Moderately cautious. Well, we don't lose you 11. We only lose you 10. So the moderately cautious loses me more money than the cautious. Well, that's bloody mis-selling for a start. Right? I mean, come on. What is going on? Anyway, I've done this one before. I'm not going to keep laboring this point. I picked these. Again, same principle. Invesco, blah, blah, blah. And that's what they were in 2022, 2023, where the NASDAQ was up 55%. Yeah, they don't try. None of them made up for the losses that they suffered the previous year. I kept saying this before. So Meta, this is one of the reasons why, you know, it's dangerous. Some of the conventional wisdom you've been given is quite frankly bullshit, for want of a better word. One of them is the whole buy and hold principle. Because if you bought and held Meta over 2 years, you got 0% return. Yeah. And you said, but Alpesh, look, it went down. Went out. See, it all works out in the end. No, you got a 0% return. If instead you either said, I'll sell X if it drops Y, like 25% or 15 or whatever, or you did my rule, which was that one. I've explained it often enough. Monthly MACD below its moving average. Okay. Then you get out. Why did we get back in there on our Telegrams and YouTubes? Well, because it was on the approved filtered list and momentum wasn't falling. So over 2 years, we get 250%, you get 0. It's those small differences that make a big difference, right? It is those small differences mathematically that make a big difference. Now I've got some good news for you. S&P 500, after 5 straight up months, which is what it's had, which are greater than a 20% gain on average. Now, history isn't guaranteed to repeat itself, sadly. It's not guaranteed to repeat itself. A few ideas from the April list, you naughty, naughty man. 1 second. I will tease you those in a second. So that's pretty good news. Another piece of good news is frequency rolling 2-year S&P 500 returns since 1950. Average positive return is 32% and 88.5% of the time you're up. So why do I focus so much on avoiding these? Why do I keep talking about monthly MACD or 25% drop from the high since you bought it? Why am I focused on that? Because as you saw at the start of this webinar, and it's mathematics, if you can just reduce that from 11.5 to 5, and you can reduce that from minus 18 to minus 9, okay, that makes a massive difference, right? Makes a massive, massive difference. Everyone's always focused on this part. That'll take care of itself, right? When everything's buoyant and you're happy, you're fine. It's these bits which actually nobody's looking at. They're all looking over here, but the action's going on over there. All right, so just wanted to say about that. You know about this, don't you? On YouTube, I've done a whole load more. It's now 1.3 million views. 1.3 million, and that's not 281, that's 330,000. I'm pleased to say that's the YouTube one, all about the pensions, and everybody said about it. So what was the questions? Let's do some of the questions now. Few from the April list, you naughty, naughty man. Okay, let me show you, before I do that, let me show you where we are on momentum stocks like Micron. Okay, did I know Micron was going to be one of our best picks? No, I didn't. I've already told you, Micron, Meta, and NVIDIA, the strategy is the same as everything else. If it drops X, sell Y. So people ask me, what do you think is going to happen? And don't kill the goose that lays the golden egg. All right? Simple. Don't forget, alpeshpatel.com/links. You've got all this free material, right? And you can see the free latest webinar there. Okay, you've got a whole bunch of stuff on alpeshpatel.com/links. And don't forget LinkedIn. Sorry, I don't know whether that's a good or a bad look, but I had to do it. It's on a beach in the Maldives in December. You would though, wouldn't you? But have a look, because there's a whole bunch of articles that I've done and I post on there, and they're all free, obviously. So do have a look at those, not least because those posts are, well, I think they're really good. Okay. Think of it like a blog, right? This is research from Daniel Kahneman on would you be happy if you were richer? I think that's interesting. Okay. And I've also done summarized some of the research on just basically how people make risk decisions incorrectly. They do it wrong a lot. And biases. So there's some stuff if you're really into academia, but there's also stuff which even if you're not, okay? And there's research from the big banks and so on and so forth, and the YouTube channel you already know about. So we'll put that to one side. Now, you wanted me to show you a bit of leg from April. Let me just say what's come up which caught my eye, okay? I'm not going to obviously reveal too much because that'd be unfair to my existing clients. But, I'll tell you what has come up a fair bit on this, and this did sort of surprise me a bit. Let me just tell you the sectors which are coming up. Now I'll mention one or two companies. Healthcare is coming up quite a bit, actually, which I don't care that it's in that sector, but it's just coming up a lot, some of the healthcare companies. Also, industrials are coming up. Now, industrials I've never really understood, even though my dad floated a dye manufacturing company which would fit within there. But what I say I don't really understand. What I mean by that is somebody says to me tech, I sort of like, yeah, I can picture it. Industrials, I just think, what the hell they're making, which is, like I say, son of an industrialist is a bit wrong for me to say that. But anyway, consumer discretionary is coming up a fair bit as well. And I tell you one that's just come up again. Now, I don't know with this one whether it's going to do it again. I'm going to share it with you. Sorry, I've got to turn this. I've got to do it in a way where you can't see stuff. Give me a second. I'm going to just blow the screen up. I think I can do it that way. There you go, Crocs. Can you see that? No, wait a minute. I've got to see what you can see. No, you can't see it. Let me put it up here. Okay, so Crocs has come up. Now, I'll tell you why this is interesting. I'll see if I can move that lower so you can see it bigger. There you go. Crocs is interesting because it's come up on the April list again. And the reason it's interesting is, look, the MACD should do this, but you might be warned off thinking, hang on, it failed to do it before in 2023. It just had a strong start and then, stopped. Basically, it fizzled out. I'll tell you a couple of other things that I've been doing. If something's on the approved filtered list, that's value, growth, income, cash flow, and the MACD is flat, which is the bare minimum I need before getting in the oversold territory, then normally I'd say, yeah, that's fine, I'll put it in. Now I'm not. If it's rising a bit, I'm still not, because we had 5 up months. I think it's going to be a bit painful going forward for a month or two, potentially. I don't know if it's going to be April. I don't know if it's going to be May. But anyway, sell in May, go away kind of thing. So I've waited this time when it's slightly lower risk and it's crossed its own moving average from an oversold position like here, like this has. But that means you miss some of the up move because actually it really should have been got in here. So if you're getting in there instead, so you're not getting in at, say, closer to 85, you're getting at 143, you're getting in later, but taking less risk potentially. Now, the problem with this is if you look at previous periods, and Crocs was, when we first launched the program in 2020, this was one of the ones which for students did ridiculously well, okay? It just kept going up and up and up. And I think that's something to do with lockdown or God knows what. Well, an Instagram campaign, it doesn't matter what, but the numbers were right on the approved list. So if you look at this, you can see it barely had any drawdown danger. I mean, okay, it had a duration where it went nowhere, but it hardly moved down. I mean, what a lovely company. And when you've got companies like that, that's great. So can it do that again? Well, it's on the approved filtered list is all I'm going to tell you. And if a history can repeat itself, that is definitely one where I want it to repeat itself. I'm just going to, I think you saw that, didn't you? Yeah, you saw that. Sorry, sometimes I do this and people can't say anything. Let me answer other questions. Okay, do you recommend hedging with 1 year outputs on the broad index? I think that's going to be too complicated for this audience. And I think the problem with hedging is unless you're already confident in doing it and don't need to ask, then that's the only occasion in which you should do it. Kishan, for those of us with smaller accounts who've been accumulating these high momentum stocks, our cost basis are higher. So from a risk reward perspective, would it make sense to get out and realistic that money is something? No, what is realistic then is to say, actually, I'm not just going to get out prematurely because what if it goes up another 20% and you've left it? So you've got two choices. You might say, well, you know what? I've made a good run. I'll take 50% now and I'll let the other 50% run. But if it drops 10% from the high for the rest, I'll get out. So you'll work it out based on your risk appetite like that. What do you use as a source for your 10,000 company list? And do you check it's correct? Are you the data for each company? Yeah. So where do we get the data from? And this is where we're having to outsource some of the corrective part is Refinitiv, London Stock Exchange, and the company's own audited accounts. So P&L, balance sheet. So we're having to rely on the company's auditors. And you might say, well, good luck with that, Enron. The London Stock Exchange data. And sometimes you might say, well, wait a minute, did the London Stock Exchange have an outage about 5 years ago? So, yeah, that's what we do with the data. Yeah, we look at those sources. All of this stuff I've mentioned before. For those who aren't on that was last year. Anyway, for those who aren't on the program already, for those interested about the Great Investments Program and how we did last year was a blowaway year. I'm not sure we will ever repeat that again because it was just mental last year. That was an 80% year, but crazy. For those who aren't on it, you know what to do and you can do it. I'm going to answer some more questions as well. Kishan, okay. Any questions? Do you recommend hedging? No, done that. High. Any chance for others? Oh, done that. Let me see if there's any others I could give you without, sort of my clients getting incredibly annoyed. What has caught my eye? And I'll do more of this as we go forward. Okay, here's one I'm not. No, that one doesn't work. Okay, I'll give you one which I'm not going to buy, just so you know. Okay, so I'm not going to buy only because I tend to focus on US stocks, and this isn't US. Where is it? I'm going to do full screen again, see if I can share the screen, for goodness sake. I've got to try and share my screen with you, so let me do that. Anyway, it's this company. I can't seem to do it. It's that company. All right. And it's TIG, Team Internet. I don't know why I can't It's not going full screen on me. I've probably put the full screen somewhere and I can't find it. So don't worry about that. I've got too many computer screens open. Right, you should be able to see everything else anyway. Oh, no, don't want to do that. So anyway, I can sort of see it. I know. Sorry, I do want to share this with you. Discard. There it is. Anyway, no, I'm going to have to do it the other way. PowerPoint don't make it that easy for you. If only they did. So as I said, these are the factors we look at. Any other questions on anything that I've said? NEM. Oh, NEM you mentioned. Yes, you did. NEM. And then I want to have a hard stop at 1900 if that's all right. So if you've got other questions, let me know. Okay. The other slide, somebody once said, look, Alpesh, we get it, because some of you have been on here before. Is this anybody's first time? Just let me know if it's your first time. Thought UK banks. None of the UK banks have come up on my further filtered list. So, I have very stringent criteria. It doesn't mean they're necessarily bad. It's just, sorry. I have spoken on HSBC's earnings on BBC, and I said to them, I said, when it was at a far lower level, January of last year, I think, or the year before. But anyway, first time watching, Dave. Fantastic. First time watching live. So anyway, the general rule is you really need to tick those boxes. Otherwise, you've not done your due diligence. 12-month holding. I generally have between 15 to 40 stocks. I've got 20 at the moment. And if it drops 25% from the peak, get out. But you might reduce that in between if you've got extra special reason to do so. Why 20? Well, because you've really mitigated a lot of company specific risk by then. The only way to mitigate market risk is not to be in the market. Thank you, Robert. Delighted you're on live. Steve, Rich, first time been finding TikTok and YouTube. Are you still holding Charles River Laboratories? Looks like a good time to get in based on MACD. Yeah, I've not changed Charles River. I've not changed my portfolio in the past. I mean, remember, most of the time it's bought and then the only reason I sometimes say to you I'm buying more of something or I'm buying this new one is because of the Great Investments Program. I want people to feel that, it's not just, he's done his in January. Now he's not interested in each month's update. Sorry, you said MEM, didn't you? MEM, I think you said. No, you didn't. Was it NEM? What was it? Tell me again. I've missed it. What you said. No, can't find it. Let me know which one it was. Sorry, I missed it. NEM. Is it a British company? What was it? NEM. Newpont? Was it Newpont? Was this the one that you were asking about? Go away. Newpont. Bloody hell. That's taken a bit of a hit, hasn't it? Well, not one I'd like to look at right now, I'm afraid. So, I mean, oftentimes what happens is, look at that. That's just still on a massive downward trend. So, yeah. Yes, Newpont. Sorry, yeah. I don't like it. I mean, that's not to say it won't necessarily go up, but it's like saying to me, you're a surgeon of humans. Can you look at my cat? That's a cat. That's a dog. That's not even a cat. Sorry, I do brain surgery, but you're asking me to look at your dog. No, sorry, mate. Ugh, don't like it. That's all I can say. Yeah, is all I can say on that one, I'm afraid. The point being to get out sooner. What's the best program for me to access? I'm a bit confused. If it's 50K, it's probably too small to be on the Great Investments Program, only because a large proportion of yours wouldn't. So I'd say have a look at the free stuff on alpeshpatel.com/links. Start with the free stuff. alpeshpatel.com/links. There we go. What I do on these programs is people will know, well, look, that's the goal, to try and get people to, with my help, get them from 10 to 20. 10 the market gives you anyway, the US ones. So turn 100 into a million over 10 years, because that's what it does. Okay. Bit of performance uplift turns 100 into a million, assuming you're still adding a tiny bit of cash each year, because you would. So it's realistic. I'm 21. Is there anything different in the approach you'd suggest if I'm 21? No. See, this is the thing. People say, oh, if you're young, you can make mistakes and take more risks. My son is 6. Okay, he's 6. So let's take an extreme example of you, Dev. My son, yes, he has 2 times leverage, Microsoft, Amazon, Apple. So he has 2 times leverage, but leverage is risky. So I'd say you still use the same due diligence as you would if you're older. And do you know what the funny thing is? Don't take my word for it. How come Warren Buffett has the same rules he did in his 20s as he has now? I mean, now it's slightly different. He's more an insurance company, but you know what I mean. When it comes to stocks, there's the same rules. So just because you're young, the notion that you can take more risk, yeah, as a matter of fact, you've got longer to live to make up for any mistakes, but it doesn't mean you don't go out and look to make mistakes, though, do you? You know, that'd be nuts. Got about 500 a month to invest. If you have, personally, look, I can't give you individual investment advice. That's against the law. But what I would say is if I had 500 a month to invest from there, I'd start, first of all, spending all my time learning. I'm almost not bothered about the 500. I'm more bothered about you learning about SIPs, ISAs. ISA, start with your ISA first, fill that up first, because you can access that anytime if you need it for a house deposit or whatever. SIP only when you're 55 or 57, depending on how they're going to change the law. They're probably going to change the law that your SIP maximum allowance will be 500,000 a year, and then they're going to tax you because they're going to need more money, and they're probably going to lift that you can't withdraw it until you're 65, and when you do, they're going to tax you at a higher marginal rate of about 70% or something, okay, because they need the money. And the best way to get it is from pensioners, because they're the ones who save the most. So that's going to come for sure, right? One way or another. I don't know when, but it's definitely going to come. You reduce the caps because people don't really notice. So you can't have $1 million saved up. You can only have less. You tax it more than even their marginal income tax rate. And those will be the things that will be coming. He has a lot of cash. What provider do you use for your son's stocks and shares? Oh, just Hargreaves Lansdown. I really should be more diligent and compare it to, say, Interactive Investor or AJ Bell or whatever. There's free trade. I've got accounts with all of those, by the way, but just happen to use Hargreaves, but you could use any others. But it's just that 2 times leverage on US stocks like Microsoft was just easy to do. Buffett doesn't sell. Yeah, I know. I mean, Buffett's comparison. He does actually sell, and he sells a hell of a lot more frequently than people think. It's a misnomer that he doesn't. What he doesn't sell are the cheap companies he bought in Coca-Cola, for instance, in 1960, or Wrigley's, because because you're buying them at such a low price that the dividends now pay so much money because you had so many stocks. So those he doesn't sell. But if you look at his SEC filings, there's a lot of churn, not in the big ones like Apple, but below the top 8, there's a lot of actually below the top 2, there's a lot of churn. So it's Apple and Microsoft that he has the biggest holdings in, and below that, there's a lot more churn than people think. Yeah, I mean, he's not a good example, so I shouldn't perhaps have given it. Hedge has no fees for junior ISAs. Oh, is that right? I didn't know. I just intend to make more than whatever their charges are, so I don't really care about their things. I like rubbing his face in it. Anyway, 9.2 billion they gave him after building him up. I mean, it's the way it works. It's a bit disheartening that the financial system works through financial media of building people up, giving them loads of money, and then suddenly discovering that actually they were crap all along, even though you could see that he barely beat Jasper the cat. And, you know, even when the paper says, well, if you're so loudmouth, Alpesh, why don't you prove it? And when you do. Anyway, I always do that. So there you go. There's Warren Buffett. Sorry, Bank of America is his second largest. I don't know why I thought it was I'm getting it mixed up with Bill Gates. Bill Gates has Berkshire Hathaway as his second largest. Berkshire Hathaway, Warren Buffett, doesn't have Microsoft as its second largest. Well, that'd break my friendship because they're quite good friends. So sorry, there you are. And they're the numbers that they've got. I'm sharing Goldman Sachs's. This isn't for you to copy. It's just to say by the time you get to the 8th largest holding, he's barely got 3% of his money in there. Similarly with Bill Gates, Coca-Cola, and then barely any in there. But that's a whole different discussion. As for Goldman Sachs, you can see what some of the exchange traded funds they have. Anyway, United Health coming back today. Oh, is it? Well, that's interesting that the healthcare companies have popped back again today because that 0.16 worry that people had. You moved to Cayman Islands, UAE, Panama to retire and avoid capital gains tax. But can't give you advice on changing your residence and how long. I think you'd have to move for 5 years or something before you lose your UK residence, isn't it? or something, and I'm not sure that would still apply on your SIPs. I don't know. I'm afraid I don't know, Kishan, about that. I have got friends who've left the UK, though. When they changed the domicile rules in 2020, I've got some very, very wealthy friends who left and moved to UAE, for instance. So that seems to be popular. Not for me. I've got friends there. My sister's moved to UAE, by the way. I was a broker at WPCT. Disaster. What's WPCT? I don't know what WPCT is. United Health coming back today. I use trading 212. I've not heard bad things, so that's okay. I probably should look at it. I should probably open a trading 212 because a lot of my students say they've got trading 212. That's croaky. This was a life-changing lunch that I had quite a few years ago. And they discovered their quantum, this is their quantum database, and it's Goldman Sachs research from their global investment research unit. And they discovered that companies in the top quartile by cash return on capital invested generated 30% per annum. Okay, 30% per annum. Not every year, as you can see, not in the financial crisis. Okay, so I just thought I'd share that with you. And that's what they use in Goldman Sachs Wealth Management for selecting stocks for their wealthiest clients. I mean, they probably use a few other sort of stories to go with it, but underlying, that's the data. And as you'd expect, they're data driven and they have an approved list, which is also where I got the idea of an approved list. They have an approved list based on, they don't go to their staff. Yeah, just pick what you think's good, mate. You're clever. That's what we hired you for, your own opinions. No, they did not hire you for your own bloody opinions. They hired you to crunch a load of numbers and wear a good suit and the same Hermes tie every day. So 30% per annum blew my mind. And that's why I have Croaky on there. And I want companies in the top quartile by Croaky. But itself won't guarantee moves up. That's why all of these things need to be green. All of these 5 columns need to be green. And none of these make it. None of these even come close to making it, I'm afraid. Okay, and as you know, that's the list. Oh, I've overshot. It's 7 minutes late. Okay, this is other people's portfolios. What I will say to you is if you are, that was my secretary. She worked for me 2 years. I keep talking about Naomi. And now she's a fund manager. And the point being, fund management is not rocket science. You can turn secretaries into fund managers. Okay, nothing against clever secretaries. Clever secretaries are actually cleverer than their bosses, I should say. But anyway, that was the whole point of it. If you're interested in the program, you know what I'm going to do. I'm going to show you that. Feel free. Let me see. Oh, Woodford Patient Capital Trust. Oh, I didn't realize. Okay. The poll results. Sorry, the poll results. Let's do some polls while we're here. Why don't we? Let's do some polls. I'm going to do some polls. Let's see. Polls. I'm going to reset that poll. So most of you think the FTSE will be higher than it is today. Let's do the Dow. Let's publish that. Okay. If any of you do want to join the Great Investments Program. So what I do is for the first 250, you're going to get me as mentor forever. After me, it won't be me. After 250, it won't be me. It will be for the first 250. And after that, there'll be a subscription, but not for the first 250. Many thanks. Where do you go to get the Croaky data? There's a formula you can find from the internet, cash return capital invested. And the formula will tell you the data to input. And then you get the data. Let's go into that. Where's the Croaky ones? There it is. So what you do, you can get from the company cash flow from operation from their cash flow statement, basically. You can get that. And this you get from the balance sheet. Okay, so you're taking the cash flow statement number and you're taking the balance sheet number, and then that's just an Excel formula, which is simple enough. Okay, so that's how we get the Croaky number on there. Thank you all for this. And like I said, if you're interested in the program, that's the program. And I always do my webinar thing. And it becomes a no-brainer, really, once you've got about, I'd say, 100K portfolio. Because if in a year you get a 15% uplift, that's 15,000 you've made in 1 year. And you've got it for life. And we don't charge a fee going forward. We just give you monthly updates and unlimited access to me if you're in the first 250. And the idea is I eventually want to float this. I want to get the venture capital investment first and then float it, because I think if St. James's Place can be a FTSE 100 company with 900,000 clients and be as rubbish as they are, then giving people this data and empowering them should make us a FTSE 100 company. Will the Dow end up higher? The vast majority of you think so. Let's look at another piece of data. Well, let's look at this and ask your opinion on this. So anyway, there's where you go. If you're interested in joining up the program, we've had wonderful, wonderful results. Any final questions before I go, do let me know, and I'm happy to answer them at all. That's first come, first serve, and it's only the first 10, I'm afraid, and then we're going to go. You guys are actually the closest to having everything. It is not an IFA. They are the absolute worst if you look at it. Okay, fund managers are the second worst. Robo-advisors probably come close. You actually tick more boxes than anybody else. And this is why on my campaign for 1 million, I'm trying to teach 1 million people how to add 1 million into their pensions across their lifetimes, because 1 million plus 1 million is 1 trillion. And that's a lot of pension money to add. Okay. And there's a ton of free stuff on here, including my Investing Unplugged international best-selling book, free portfolio review, copy of Mind of a Trader, free, investing, all the rest of it. That's all on there as well. Latest webinar. There's just a ton of free stuff. Free bank stock forecasts. Okay, just loads of free stuff to teach you, including blogs. Okay, so you've got articles there. You can see it here, right? On that website as well. So do enjoy. Oh, thank you, Ravi. I didn't know you were here. Thank you very much. I'm going to broadcast that, my friend. Broadcast comment to room. You are very, 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 very kind. Thank you. Oops. Oh, everybody on here is on stocks. Well, that's good to see. That's interesting that everybody's into stocks. So any other questions, let me know. And then I'm going to, whoops, there's the campaign for 1 million site anyway, which you might like. Holzer, well, I look forward to seeing you on the 19th. Yeah, you've got to get in yet, mate, for the 19th. I will try and squeeze you into that. There are only 9 seats. We're having a dinner at Lincoln's Inn for those on the program. And Ravi is, I'm going to say it, you're my favorite student. I've never met one so enthusiastic, but also, you know, it's been life-changing. He'll say so himself. And I love that. So I do like to have you come to the events and stuff. Because I think that's fantastic. In fact, did I already confirm you? I might have confirmed you, which is why he's saying I look forward to seeing you on the 19th. I might have said, forget it, you're in. You're just so infectious. So we'll see. Okay, that's that. Which program are we talking about? I'm already on GIP, so do I qualify? Yeah, if you're on Lana, yeah, you should. Do you not look at the... I didn't send the email today. Look at the private Telegram channel. It's on there, Lana, or just email me. You do qualify if you're on Great Investments Program, Lana. Absolutely, you do. And it's on the 19th. And we had one at the Cinnamon Club a couple of months ago. So you'd qualify on all of these. Email me, and I'll make sure you're on the private Telegram channel, because you must be missing that. And we can do a retour, as it were, of all of that for you. Okay. What did I want to show you? Oh, there's some great articles I've put up. Oh, I forgot to show you this. Okay, so there are some really good ones. Come on. I'll take you through. So if you go to alpeshpatel.com/shares, you will see a bunch of articles. Do you see these? Okay. These are really rather good, and it's worth looking at these. So alpeshpatel.com/shares. Do have a look. Your comment about the cost being returned is spot on. Worth every penny and keeps. Oh, thank you, Theo. That's wonderful. Made my day, Theo. Thank you very much. And we've started doing so much more stuff than we ever used to before. So, Theo, you'll be familiar with that. I'm a broadcaster. I used to work for the only chartered accountants in Lincoln's Inn. Oh, right. Which ones were they? Let me know. So I was at 7 Stone Buildings on the corner. You'll know, well, above Briefs, the student cafeteria, which I think they've got rid of Briefs. Sorry, but how do I find you on private? Lana, email me. Have you must have my email address, Lana, from being on the program. So just email me, and what we'll do is we'll just we'll do another tour. I think you're one of the early signups, because I've not seen your name pop up for a while. So don't worry, we will do that. Get your name onto the everything and get everything set up again to make sure you're getting all of this. So I don't want you missing the value of all of this. So look, thank you everyone. And yeah, do have a look at these on alpeshpatel.com/shares where it says preview. They're rather good. And I mean, basically it's all on, I'm giving you too many links. I know I'm giving you too many links and I apologize for that. It's alpeshpatel.com/shares. If you go to the free stuff on Investing Champions here, okay, if you go to the free stuff here on investing-champions.com, I did just do a bunch. This is all free, and this is where you download the free book from. Okay, I did. This is all free. This bit's all free. Okay, it's the free bit. I just uploaded these at the weekend. Nobel Prize winning research behind this, and the reason is because one of the people I used to write about in my Financial Times column just passed away recently. Daniel Kahneman this past week. So I went through his papers again, and I've summarized it in very simple terms, such as judgment under uncertainties. You can see the original paper he wrote, which you might say, thanks very much, mate. I don't want to read all of that. Are you nuts? But don't worry. What I've done is then summarize it, what it means if you're an investor. So I made it specific for investors, and you can see it's very readable. If you've got the time, I highly recommend it. So it's all free on the free part, investing-champions.com. So have a look at that. And this is on alpeshpatel.com/shares. I apologize. There's so many links. You can find them. You can just email me if you get confused. Okay, I'm going to go now. Got swallowed up in takeovers. Okay. Yes. Well, that's happened with a lot of accountants. Yep. Understood. Thank you all very much indeed. I think that's me done. And thank you for everyone who signed up. I am going to send you an email. Allow me about 20 minutes because I've got to get home first. So thank you all very much indeed. And I will speak to you all very soon again with another update. Thank you. And Lekit, don't forget, and Ravi and Lana and on the private channel, those that were on the program, Theo, on the private Telegram channel tonight, I'll do the market update for the people on the program just for you guys. Okay. Thank you very much indeed.